Hello everyone, welcome to our session on discontinued operations and unusual items. We're going to go over unusual and infrequent items. There are two terms you are going to see. One is the strategic shift and the other one is the held for sale. We will go over the criteria for them. Then we are going to go over some calculations, some impairment operations and disposal gain and loss calculations. And we're going to go over some of the CPA exam tracks, especially the net of tax rule. Unusual and infrequent items are highly abnormal transactions not expected in the foreseeable future. So what they could be, maybe there's a natural disaster, or maybe there are some foreign currency losses, or maybe there are some strikes. By definition, when you look at them, you can see that those are abnormal transactions and they are not expected to recur in the foreseeable. They're not natural disasters every year. And where do we report them? We report them as income from continuing operations, as a pre-tax amount, gross amount. If the item is material, we report them in a separate line item. Building on our understanding of unusual items, discontinued operations represent a significant event for a company. This involves a component that has been disposed or classified as held for sale. So the crucial condition is that the disposal must represent a strategic shift with a major effect on the entity's operations and financial results. This is not just like selling a small asset or a small building of a company. By this one, we mean there are some fundamental change. So what constitutes a strategic shift? It means the major effect on overall operations and financial results. This is not a minor adjustment. It's a significant change in direction. For example, exiting a major line of business, like leaving the smartphone market to focus on software. Imagine Apple says, we no longer do iPhone, we only focus on MacBooks. Similarly, closing operations in a major area or selling a significant equity investment also qualified. So understanding these examples help you identify true strategic shifts on the exam. We're going to explore for sale criteria, which is another key component for discontinued operations. Okay, so before we calculate any gains or losses, we need to understand when a component qualifies as held for sale. This is not just a casual decision. It requires meeting several strict criteria. First, management commits to plan to sell. Then there's an active program to locate the buyer has been initiated. The sale price is reasonable compared to fair. The component is available immediate sale. The sale is probable within 1 year, even if it does not happen. Here, the term we are looking at is probable, and unlikely that significant change to the plan will be made. So what does happen if we meet those criteria? The first thing we need to do, we need to stop depreciating the assets. Okay, then once a component is classified as held for sale, we combine three key elements to determine its total impact. First, consider any impairment loss, the initial write-down. If net realizable value is less than book value, put it here. Secondly, include operating income or loss for the component for the entire year, even after disposal. Finally, add the actual gain or loss when the component is sold. All three components are combined and reported as a single net item, net of tax. This leads us to understanding the net of tax rule. Okay, so what is the net of tax rule? So this is a fundamental concept for discontinued operations, a very common exam trap. Okay, so income from continuing operation is always reported gross, which means before tax, shown as a separate line item. However, income from discontinued operations are always reported as net of tax, which means we already subtract the taxes. Why do we do that? So because those operations are no longer a part of our ongoing business, so we show their final after-tax impact on the bottom line, clearly stated that from the results of our continuing operations. This is basically more to the readers of the financial statements. We separated them and tell them this is the last time we are doing it and the net effect. One thing to remember, okay, if you think, is this company going to continue this work or operation next year? If yes, then we report gross before the tax. But if it's from discontinued operations, which means we no longer involved with that operation, then we say, okay, we are done with it and we report net of tax. Let's do intra-period tax allocation. So this is the practice of assigning income tax expense or benefit to the specific financial statement components for continuing operations. Tax is shown as income tax expense. But for discontinued operations, the tax effect is netted against the gain or loss. This reported figure for discontinued operations already has the tax impact factored in. It's not a separate line item. And this allocation ensures that each section of the income statement accurately reflects its after-tax contribution. I know this all sounds very dry. Now let's do an example and see how it's going to look in practice. Okay, so let's focus on an example of a disposal in the current year to solidify this concept. So we have an operating loss of $100,000 and a gain on disposal $150,000 with 30% tax rates. Okay, so what do we do? So number one, we combine the pre-tax amount, so the $150,000 gain and the $100,000 loss. Here we have a gain of $50,000. And the next we calculate the net of the tax amount. So basically, if our gain was $50,000 and we subtracted 30% of the tax, which is our 30% tax rate. So here our reported gain is $35,000. Now let's do a slightly different scenario that involves an impairment. When an asset is classified as for sale. Okay, so once we classify an asset for sale, the first thing we do is we test it for impairment. So let's do an example here. So we start with a book value of $100,000 for the asset, but when we look at the fair market value, it's $80,000. Plus, it's going to cost us $5,000 to sell, and we have 20% tax rate. Okay, so what do we do here? First, we calculate the $5,000 to sell. So our net realizable value is $75,000. Okay, now let's compare this with our book. So when we look at our books, we thought this asset $100,000, but in reality, there is a $25,000 impairment. We are going to report this one. For the items that are held for sale, we are reporting them as net of tax. So basically, we had a $25,000 impairment, and we are in the 20% tax rate. So our reported loss is $20,000. Here's a common exam trap, mostly seen on simulations. It is very easy point. It's a mistake. Candidates see a question that's for an item that is held for sale. They usually forget to test it for impairment. So what I mean by that, they only include the operating expenses and not those losses until the item is sold. So remember the previous example? Once the company decides that there is an item that is held for sale, we immediately check it for impairment loss. If the book value is greater than the fair value minus the cost of this, we record the loss right now. So basically, the reality, if the component is held for sale, whether it's sold or not, we immediately test for impairment. Never make the mistake, only include the operating loss for the year. Make sure to include the impairment loss if the item is held for sale. For example, let's see, maybe you got a question and it gives you an information. It says, loss from discontinued operation is $100,000. And they ask you, what is the effect on the net income? You always need to think of the net of the tax. Assume it's 30%. So if it's $100,000, the effect is $70,000. Let's give an example, practice questions. Which of the following disposals would most likely be reported as discontinued operations? First, phasing out a product line that represents 2%. This is not significant. Shifting production from one factory to another, no strategic shift. Disposing old machinery replaced by newer models. Selling a major subsidiary that represents a strategic shift. This is obvious. As you can see, those are like the old ordinary business activities and they are immaterial. Let's see another question. Okay, in this example, the company has an operating loss of $80,000. They also have a gain on disposal of $30,000 and a tax rate of 25%. What amount is reported as discontinued operations? First, we calculate our net amount. We had an operating loss and gain. In the end, we have an operating loss of $50,000. We calculate as net of tax, the amount one minus the tax rate. So here we reach 37,500. Okay, so let's do another example. So here we have another question that is asking us what is our impairment loss. Here it told us even net of tax. In the example, we have a $500,000 book value, and then the company decided this item is held for sale. And they said, okay, the value is 420, cost sale is 20, and the tax rate is 30%. So net realizable value of this item is $400,000. Basically, if they decide to sell it today, it's going to be $400,000. But on the books, it was $500,000. So we are having $100,000 loss here. We are going to book on our books. We book the amount net of tax. So if we have $100,000 loss, the net of tax amount would be $70,000 if the tax rate is 30%. Key takeaways. If there's a disposal, it must represent a strategic shift, something much bigger. This one we report below the continuing operations and we report them as net of tax. We include impairment loss, operating loss, and gain or loss on disposal. And once we decide an asset is classified held for sale, we stop depreciating it. So here's a tip. If a question gives you a pre-tax loss for discontinued operations, multiply by 1 minus the tax rate before answering. Because we already have a loss, like the tax works the negative way here. Okay, so coming up next is the last part of the income statement portion. We're going to go over the comprehensive income and changes in equity. We're going to go over the other comprehensive income, accumulated other comprehensive income versus net income. Thank you.